Hello, everybody, and welcome to The Real Deal, your up-to-date real estate and financial analysis of what's going on in today's market. My name is Kristen Ayers, and I'm your local lending expert from Finance of America. I've been in this industry for about 20 years. I have another expert with me, Andrea from West USA Realty. And what we're going to talk about today is the state of the market and update you on where we are with COVID versus the market crash of 2008. Welcome, Andrea. Can you tell us a little bit about yourself and also where you get all of your good information from?
Yeah, my name is Andrea Francis. I'm an associate broker with West USA Realty out here in the greater Phoenix area. I've been in full-time real estate for about 6 years. I work with buyers and sellers, investors, and I also flip homes on the side. And it's really important to be watching where you're getting your information. Where's the source? Where's it coming from? So I'm looking at the local and national levels of Association of Realtors. We have a great chief economist, Lawrence Yoon, that puts out some amazing articles and interviews. I also belong to a program called Keeping Current Matters, and that is a team of 25 different researchers that is analyzing the national data, making sure that we have good, accurate information to pass along to you. And on a local level, we have the Cromford Reports, which is an amazing analytical company out here in the area that takes our local housing data, puts it into a program where we can pull reports and see exactly what's happening down to the zip code and price range, so we know what's happening in our current market here locally.
Wow, Andrea, I'm really glad to hear that you've done all of this research to figure out if the markets are the same. Are we looking at an apples to apples comparison when we're talking about 2008 versus 2020, or is it more of an apples to oranges comparison? And really, I think the question on everybody's mind is, are we heading off the cliff for another 2008 market crash?
So in a quick word, I'm going to say no. And there's a lot of differences that led up to that housing crash that are totally different now. Back then, it was really a housing and lending industry crash. Right now, what we have is an external health crisis. The economy is affected. Yes, we are in a recession. I'm sure data will show that. But I'd say the effect is more like the effect that 9/11 had on our housing, which was very minimal compared to what happened in 2008.
So what are some key factors that you see that are different of the events leading up to 2008 versus what's going on here in COVID 2020?
The key factors that let us know that the housing market will not be affected in the same way as what we call the Great Recession are the differences we have, first of all, in lending guidelines, and then appreciation rates and how they grew back then versus what they're doing now, the amount of inventory that we have on the market, and how much equity people really have in their homes and how they're treating their equity. So as to that first point, lending guidelines, what do you see are the differences back then versus now?
So if you look at the Mortgage Credit Availability Index, what you can see is back in the day prior to 2008, they basically handed a loan out to anybody who wanted one. This happened because of a lot of different things. The programs were really loose. And one of the loans that they had back then was called a SISA loan, which is a stated income, stated asset loan, also known as a ninja loan. And what that allowed people to do is basically just state whatever their income was. So if they were making $30,000, they could add a zero onto the end of their income, and poof, they made $300,000 and they were able to qualify for a $1 million loan. Now we know that's not tenable because eventually the loans come due, and that person who's making $30,000 could not afford to make those payments on a $1 million home. So a lot of people were upside down on their homes, couldn't afford it, and that ended up being a huge problem as people walked away. So when the Dodd-Frank Act came into play back in 2010, what that did is it leveled the playing field for everybody. Everybody had to follow the same rules, which meant that lending guidelines became very strict. And when I mean strict, it just meant that we verified the income that you made. We made sure that you actually had money, and we made sure that you could afford the home that you were purchasing. So what did that end up doing for the real estate market on your end?
Well, one thing that came into play is appraisers were not allowed to overappraise. So the appraisal industry had a lot of safeguards put in place as well. They developed what's called the Uniform Collateral Data Portal, which is a program that will put up red flags, risk scores, if appraiser is overappraising for a certain area. If that appraiser continues to do so, they'll be blacklisted and no longer allowed to appraise. So that helps keep the appraisal levels, the value, the appreciation rates at a better, stable pace.
I recall back in the day, I was able to talk to appraisers before the appraisal was even ordered. Nowadays, with the Dodd-Frank, I'm not allowed to know who the appraiser is. I'm not allowed to communicate with them at all until the appraisal hits my desk. So how do you think that directly affected home values, all of these new rules that were put into play?
So looking at the rate of appreciation leading up to the housing crash, we had 6 years of some out of control appreciation rates versus the past 6 years leading up to COVID 2020. To put it into perspective, our highest appreciation rate over the past 6 years is lower than the lowest appreciation rate leading up to that housing bubble.
Wow, I can really see that in the chart there. It's interesting about home values. How did that affect the inventory levels?
So real estate inventory is measured by month's supply. If you take our current number of homes on the market at our current rate of sale, how long would it take before you sold out of inventory without adding anything new? So if you take a look at the 2007 month supply of inventory, back then at a national level, we had 8.2 month supply. And in our Phoenix area, we had 11.8 month supply. And today, on a national level, we have 3.4 month supply. And today in Phoenix area, we only have 2.4 month supply. So overall, we're not oversupplied. We're actually very undersupplied still.
So looking at how that relates to real numbers in 2007, I think that we had approximately 50 to 60,000 homes on the market versus what we have on the market right now. I recall looking on MLS at the beginning of the year, there were only 15,000 homes that were available. Now I think right now in May, we're looking at about 18,000 homes available, which means a lot. And it means that the same people are competing for the same homes, correct?
That's correct. Here's another chart that talks about the differences. And you can see in 2007, this blue line up here, the inventory was just at an astronomical amount and month supply versus the green line is all of last year. And this brown line is showing 2020. And we entered the market at such low inventory. And now we're about the same point that we were at this time last year with our amount of inventory.
Right. So when we talk about that in layman's term, we always hear people asking if that's a buyer's market or a seller's market. Which type of market are we in right now?
So a buyer's or seller's market is determined by supply and demand and the rate of sale and month supply of inventory. So on a national level, they say a neutral market is 6 to 7 months, but I'd say on a local level, it's more like 5 to 6 months supply of inventory. And as you can see, we're only at 2.4 months supply. So we're really in still a very strong seller's market.
You had mentioned that equity is different. How are equity positions different this time around than they were back then?
So with the appreciation rates growing so rapidly back then, people were really starting to treat their homes like an ATM machine.
Wow, Andrea, I think you used a really great example about people using their homes as an ATM. When we look back onto what people were taking out of their homes back in 2006, 7, and 8, it was about $800 billion of equity taken out of people's homes. With the Dodd-Frank Act that actually required people to have some skin in the game, you're looking at approximately $230 billion that have been taken out of people's homes today. So with a $500 billion difference, what that means is that people have equity in their homes. So where people before were taking out loans to 100% of whatever their house was going up, you had that really high inflation on the homes. And so people kept on taking out the cash. And so when all of a sudden the market crashed, they didn't have any equity left in their home. And I think that's a really good point to make out, is that there is such a huge difference between the two.
That's right. That's one of the major reasons that we're not going to see the amount of foreclosures that we had in the downturn of the Great Recession. So many people now are equity rich. They have 50% of homeowners have over 50% of equity in their homes, which is giving a lot of homeowners a lot more choices. They could choose to do a loan modification, refinance, or sell their home if they really get into trouble.
Wow. Well, I'm glad that homeowners have a lot more options out there, but it's really hard to pick out the information that is accurate versus the information that isn't. what have you been able to figure out of what of that information is accurate?
I do hear reports that the market's crashing also, and you always want to vet your sources, make sure you know what you're looking at. So one thing that is accurate out there is that the sales volume is down, but volume does not equal the equity in your home. It does not equal values. So one thing we can look at here is on this chart is showing the number of contracts we have under in escrow right now. And you can see the beginning of the year we hit with a frenzy. There was coming out of December, it's always slow. We pick way up, and then COVID 2020 hit about right here. And our volume of listings under contract definitely went down, as well as the volume of, in this orange line, that of the listings that fell out of escrow with fear or whatever was going on with people's minds. And then also they're not shopping, they're staying at home. So they're not out there looking at homes as much. So definitely our volume has been affected. And you can see it's already started to turn around. The number of fallouts is back to a normal level, and our number of listings going under contract is picking back up.
Wow, that looks like a really positive sign of the contract starting to go back up. So basically, the bottom line, after we're taking all of this information in, what I have gathered through everything that you've taught us is that lending is different than it was before. We don't have stated income, stated asset loans. Dodd-Frank made a level playing field. We also don't have the same appreciation rise that we had before. It's a normal uptick, which is nice. The other part about it is inventory. If inventory is low, that means that housing prices are going to stay higher because there's just less to choose from. Nobody has to sell their home quickly. We also have use of equity in your home. If people are not using their homes like piggy banks and they're not taking the equity out at 100% loan to value of their home, that means that they're going to be equity rich in their homes. And that's a really positive thing, because if people have options when crisis hits, that means that they don't automatically have to go straight to foreclosure. They don't automatically have to go to a short sale. That means that they have options. So through all of this, I happen to think that we are not heading towards the crash of 2008. I think this is very different. And I really appreciate you coming in here and giving us factual information so that people can draw their own conclusion as to what's going on. I want to say thank you once again for joining us. My name is Kristen Ayers. I'm with Finance of America. And thank you, Andrea, for coming and joining us.
Thank you for having me, Kristen. We want to make sure that you all join us next time for The Real Deal, your information resource for finances and real estate out here in the greater Phoenix area. I am Andrea Francis with West USA Realty. Our contact information is there, so feel free to reach out if you have any lending questions or real estate questions. We're here for you guys.
Thank you so much.